Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's switch gears here. A little M&A here in the satellite television space. I never thought I'd see the day. DirecTV and Dish. They're going to merge to create the largest U.S. pay TV provider. Let's get the latest on that. Geetha Ranganathan joins us. She's a U.S. media analyst for Bloomberg Intelligence. Geetha, this is big news in the satellite business. You really only got two satellite players out there, and now looks like they're going to be merging here. What's driving this deal?
What's really driving this deal is desperate times kind of call for desperate measures, Paul. So satellite TV has steadily seen an erosion of its subscriber base. I mean, at one point, it was the only other game in town, along with cable TV, for people to get access to different pay TV packages. Today, the world is a completely different place. I mean, you have cable, you have satellite, which is, of course, the traditional facilities-based operators, but then you also have a whole slew of new internet-based options, whether it's a YouTube TV, which gives you all of the linear TV options, or whether it's like completely different what are known as SVOD services, subscription video on demand services like an Amazon Prime or Netflix. And so the world today is completely different, and because of this, satellite TV has seen a huge erosion of its subscriber base. Dish and DirecTV, once upon a time, they were some of the largest pay TV operators. They have lost about 63% of their satellite subscriber base just over the past 7 years.
That's unbelievable. Did two wrongs then make a right / will regulators like it?
So regulators, of course, squashed this deal back, about 20 years ago. But then again, it was a completely different landscape. They have to kind of understand that things have completely changed today. One of the main appealing points of satellite TV, why people even take it in the first place, is because in a lot of areas in rural America, this is the only way that you can get access to pay TV. But things have been changing because, we've had this whole initiative to narrow the digital divide. So more and more houses in rural America are getting wired up. And with that, they now have the option to switch to internet-based TV, which is, exactly what Dish and DirecTV are saying. This is the reason why they've lost subscribers. So this is the reason why there is more competition, and therefore regulators should allow the deal to pass.
And I guess a parallel announcement here today is that TPG Group, the private equity company, is going to acquire AT&T's 70% stake in DirecTV that TPG doesn't already own. So in effect, a private equity owner is now going to own the entire U.S. satellite television business. What's going on there? Why is this happening?
Yeah, exactly, Paul. So it's, Charlie Ergen walking away from the pay TV business. And in many ways, again, AT&T also walking away from the pay TV business. And as you well know, AT&T had invested heavily in the media businesses. They had bought the whole Warner Brothers operation, which they kind of got rid of, selling that to Discovery. And then, of course, they had also bought the DirecTV operations, which they sold a 30% stake to TPG. They still retained a 70% stake. And of course, today with that deal with TPG, they are completely exiting that business. And for both of them, if you kind of look at what, is the final end game here for both AT&T and EchoStar, or the other part of the Dish business, it's they really want to kind of focus on their core business, which is the wireless business. For AT&T, of course, it's the wireless business. For EchoStar, they have they've amassed a huge amount of spectrum, and they ultimately want to become the fourth largest wireless player in the United States. And this deal really helps them do that and kind of focus their resources, investments, time, and energy on just that part of the operation.
This might be a dumb question, but do they grow their customer base at this point? Is there a customer base to grow? Or as you said, do they just become better at execution and they kind of cut with synergies and that's how they become successful?
Yes. So yes, they are looking at they outline about $1 billion in synergies. A lot of those will, of course, be programming costs. They still will be, with the combination, they still will be the largest pay TV operator. They will have about 19 to 20 million subscribers, but there's not a whole lot to really grow, Alix. So it's really more kind of stemming the declines, if you will, just reducing the bleeding and becoming much, much more efficient in kind of delivering customized, tailor-made packages for the pay TV market.
Hey, Geetha, just about 30 seconds left. What's your forecast for just the overall pay TV business? Are paying subscribers going to go to zero? Are we going to be all streaming stuff soon?
I hope not, but we're definitely seeing that YouTube TV is becoming a major player in the market. Again, they are delivering linear TV channels. They right now are about the third or the fourth largest operator, 8 million subscribers. So they actually have more subscribers than Dish has on its satellite business.
Wow.
But we eventually, in the next 2 to 3 years, see them becoming the largest player, and then that of course changes the whole dynamics of the whole pay TV market, because then you have a streaming-based operator that's the largest operator of the pay TV market.
And again, the DirecTV and Dish getting together, DirecTV is paying $1 for the equity and assuming all the debt. So talk about an inglorious end to the pay TV business from the great Charlie Ergen, who built that satellite business from scratch about 30 years ago. Geetha Ranganathan, thanks so much for joining us. U.S. media analyst for Bloomberg Intelligence, joining us from Princeton. And again, kind of an end of an era for Charlie Ergen. Again, one of the leaders in satellite television, in satellite technology in general, and commercial telecommunications, putting up those satellites 30, 40, 50 years ago. So just walking away from that satellite television business, focusing on the wireless spectrum that he still retains.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get to the story. Dani Burger, Bloomberg Television Anchor, joins us now. She is at the Port Newark Elizabeth in Newark, New Jersey. So she's on the ground. She's been talking to the people. Walk us through, Dani. What's the scene there? Set the scene for us. What's it like?
So we are at this point just some 16 hours away from a potential strike. The next update we're waiting for is the International Longshoremen. They're set to release an update at 11 a.m. New York time on the current status of the strike. But by all accounts, it will be going forward at 12:01 a.m. on Tuesday. That's when the current contract expires. There are no scheduled talks until then. So it seems like we're unlikely to get an agreement. The two major sticking points, one is about wages and benefits. They want some 80% increase in pay over the next 6 years. They say what's currently on offer is, quote, stingy. They also want language in the new contract that prevents further automation of these ports. Automation, I should say, that is really prevalent in other places like Amsterdam and Asia. It's pretty standard, but they don't want it here because they don't want the jobs removed. They have a pretty strong hand to play at the moment. They have an administration in the Biden administration that's very friendly to labor. And they also have a supply-demand issue. There's not enough people who want these jobs, which, of course, is part of the reason that the workers here, the employers, want to automate these ports.
So what's the expectation here? It doesn't seem to be any emergency feeling that they need to get something done here. Is there a sense that this could be a long potential strike here?
Most of the people that I've been speaking to think that this will just last a couple days, really just because there is so much pressure. There is so much money at stake. Not to mention, as I said, this is a friendly administration to them. If they stretch this out and it gets closer to the November election, what happens if they realize that the next administration coming in won't be as friendly to them? Now, a lot of companies, a lot of retailers have been trying to stock up in anticipation of this. So if it just lasts a couple days, the thinking is that most people could go around it. But if it does last longer than a couple days, it takes time. Ships will kind of build up on the ports around me, like you see, and they need to offload it. So something that lasts, let's say, a week, it could end up taking months to resolve itself. There's also not a lot of other options for ships to go to. The West Coast ports, Canada, they can't handle the same amount of volume and really absorb everything that's supposed to be happening here on these East Coast ports.
All right, Dani, thanks a lot. Really appreciate it. Dani Burger joining us there on the port strike. She joins us from Port Newark Elizabeth over in Newark, New Jersey. Let's get more analysis with Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst, joining us on this. Hey, Lee, what can be rerouted? What can't? And how does this all work?
These are great questions. So what can be rerouted are things that shippers needed to have the foresight to reroute a couple months ago. So if a ship is expected to hit the East Coast ports, it's not so easy for it to find another port of call to find because there's schedules that these ships have to adhere to. So the more sophisticated shippers probably have been plans in place that are currently, bringing freight to the West Coast or maybe East Coast in Canada. And we're seeing that. We're seeing that in the really huge volumes in imports at LA Long Beach last month. So we're seeing that it's happening now. Obviously, if there is a strike, and it appears that there's going to be a strike, and there's high value, time sensitive freight that needs to get somewhere on the East Coast, there's always air freight. We haven't seen that much movement into air freight right now. It's really just being diverted to other ports where they can come in. And once they come from the West Coast, they either can get trucked across the country or they can put it on trains through intermodal. And this is actually a net positive for a lot of companies that I cover. So I cover companies like Union Pacific and J.B. Hunt and Werner and Knight Swift. These are all companies that will probably benefit from this in the short term because it really should provide a boost to spot rates in the market. And a lot of this business is going to go in the spot market.
Lee, how about some of the shipping companies and logistics companies that you cover? What are they saying from their perspective about how much pain they're willing to take, how much flexibility they're willing to have in these negotiations?
Well, Maersk, mentioned that they're going to, put out a surcharge for the additional costs that they're going to face. So they're looking to pass on any additional costs that they might have, whether it's their ships waiting by the ports and to unload or whatever those additional costs might be. So they're hedging themselves. But it really seems like the two sides are really far apart from, what I've been able to glean. It seems like, the raise that the port workers want, the ports are about 50% below what they're looking for. So there's a lot of middle ground that has to be made. And we do expect a strike to happen. But like a lot of the people that have been speaking before me, a strike probably won't last that long. And if it lasts more than a week or two, call it, I think the federal government will definitely step in with the Taft-Hadley Act.
Right, which basically says that they can get involved and restrict the activities and power of labor unions when it winds up upsetting the country, basically, and they can't sort of function as a whole. So to this point, then, if we get something, let's just say 50 to 70% wage increases over 6 years, what does that look like for the companies that would be involved for that?
So I don't cover the port operators themselves. I cover Maersk, which has some port operations. I mean, it will just mean that their costs are rising. Right now, those are pretty good businesses. I think the more interesting thing from my perspective is the union's inability to accept the reality of automation. Obviously, they want to protect jobs, but in a world of AI, and productivity improvements, whether that's, in offices or on docks, there's really a lot to be said there. And it would be a shame that, the U.S. ports wouldn't be as competitive to other ports around the world.
All right, Lee, thanks so much for joining us. Always appreciate getting your time. Lee Klaskow, he's the Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence. He follows everything, the rails, the trucks, the sea ships, all that kind of stuff, logistics company. So he's our supply chain expert. He joins us from BI down in Princeton, New Jersey.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is Bloomberg Intelligence Radio. We cover all the top news in business, economic, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. We also sometimes go outside that and just take a look at the broader market and get the nice macro view from some people who run money. And for that, we go to Jerry Cudzil, Group Managing Director and Generalist Portfolio Manager over at TCW. He joins us now from LA. There's lots of different ways to go with this, but I'm looking at a stock market that's a little softer. You have yields on the front end there a little bit higher. What is the pain trade right now for you, considering the massive movement into Chinese equities that we've seen? Where's the pain trade right now?
Well, thanks a lot. Appreciate being on the show. I tell you, this rumor about 280 gas prices has me I think you guys are lying. At LA, it's $5 still.
Well,
for
you have
gas
a whole
in
different
LA.
problem there in LA. So there's that.
We have a whole different problem. But what I will say is, pain trade for markets appears to be a concern about inflation, and what we would say is that's not. I don't think anyone is really concerned about that. It feels like the Fed is trying to, and I think, look, hat tip to the Fed so far. They've controlled the narrative really well. I mean, you've reset expectations only from June 1st to move rates 100 basis points lower. We had one cut priced in by the end of the year, June 1st. We're now going to have about 6, and ultimately the valuations really have been unimpacted. So hat tip to the Fed so far. Feels like the market's embracing the idea of a soft landing, the idea that lowering of inflation is a good thing, and we'll see. Ultimately, we'll see what proves out. But I think the data, certainly there's something in there for everyone as it relates to economic data right now, the bulls and the bears.
How much risk should fixed income investors be taking these days, given that rates are coming down?
That's a good question. Look, I think as we think about it, I think there's a bunch of ways to answer that question, Paul. But the reality is, rates are going to come down because inflation expectations are stable. I think the right question to ask is, why are rates coming down? Are rates coming down because demand is, the economy is slowing, and have a potential issue? And I think we'll learn a lot more as we move through the week. We're going to get a couple of economic numbers this week that will probably be pretty impactful. I would say we like fixed income broadly. You can create income in portfolios. We like the belly of the curve. What we don't think you should be doing is taking significant amount of credit risk in portfolios. We've talked about this a bunch on the show, and the reality is the risk-free rate gives you 85% of your yield when you consider investment-grade corporate bonds. And when you pull this back historically, whether you're looking at high yield or you're looking at investment-grade credit, at the end of the day, you can get the majority of that yield in the risk-free rate. And we like the belly of the curve and the front end of the curve because we think inflation expectations are stable. The curve will continue to steepen, and you'll be able to generate some healthy income without taking this volatility. We don't think you need to introduce that in your portfolios with significant amount of credit risk.
There's still money, though, flowing into money market funds, kind of like unbelievably. And the money hasn't come out of money market funds, to say the least. When does it, and where does it belong in fixed income after that?
That's the $7 trillion question, right? That's the reality. Where's the money going to go? The market at the moment is comfortable that rates are coming down, but ultimately you need the rate to come down. We think to see that money move. And where's that money going to go? Well, it's going to kind of go everywhere. I think our opinion is it will benefit the markets, but I would just pause and for us, what we would say is we're a little bit more concerned about the direction of the economy, where it's heading, and really a function of the labor market. And I think we're seeing some slowing in the labor market. And whether you have a lot of money in markets or a little money in money markets, when people lose their jobs, they don't spend money, and that slowing in the economy is we think is going to overwhelm any kind of short-term movement of money, and really going to challenge risk assets, at least performance of risk assets in the near to medium term.
Hey, Jerry, thanks so much for joining us. Appreciate getting your thoughts there. Jerry Cudzil, he's a group managing director and a generalist portfolio manager at TCW, joining us from their home in Los Angeles.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get to the other significant story, I think, out of the day, which is just this real sell-off in global auto stocks here. Stellantis with a profit warning that came in much more egregious than maybe I think people were discounting. That stock is off 13, 14%. Craig Trudell, Bloomberg Global Autos Analyst. He's an editor there. Bloomberg Global Autos Editor on the slowdown in the European auto industry. So, Craig, it seems like this auto industry globally, certainly for the European operators, the North American operators, this transition to electric vehicles is proving much more, I guess, difficult than maybe the market had anticipated. Where are we here? What's happening with these big auto companies?
Yeah, I think that's spot on. I think in the case of Stellantis, you had a company that, especially in North America, was really taking its sweet time in terms of going electric. And they're now really caught in a bind because they've spent an awful lot on playing catch up. They have, some electric vehicles, some plug-in hybrids coming to market, just as that market really slows down, and they've maybe invested in that at the expense of some of the vehicles in their lineup that really were strong sellers and that dealers were quite fond of. You look at Jeep or Ram, some of the major brands that Chrysler has for a long time been shepherding in the U.S. This is a company that has way too much inventory, has been trying to take too much price for too long, and the CEO Carlos Tavares has taken some blowback over that, even from dealers, and in a really unusual way for the head of the U.S. Dealer Council to issue a public letter a few weeks back criticizing him and criticizing the company was really remarkable.
What I'm having a hard time understanding is why it's hard for these companies to get a true handle on why things are bad. So just the idea that Stellantis cuts its forecast again in just a few months, why is it so hard for them to get a read on their own business?
Well, I think in the case of Stellantis, you've seen actually sort of a reluctance for them to lower their guidance. So they did release a very disappointing first half result a couple months back. But the companies that maybe have had a harder time getting a handle on earnings, I would put Volkswagen in that camp. They've had their second warning in the matter of a short period. I think Nissan may be next, as we reported earlier today. I do think that this is a case where automakers globally very quickly went from this position of being production constrained and looking to move as quickly as they possibly could to ramp production back up. And once they were able to get through the many supply chain issues that they've had over the last few years coming out of the pandemic, it really took them some time to adjust to the fact that at some point they were going to get to where they were no longer production constrained, that demand wasn't going to live up to what everyone was making, and it was kind of a matter of who was going to blink first. And I think Stellantis maybe is getting bonked on the head today because they were one of the last to really sort of bow to reality that they had way too much supply relative to the demand that was out there.
So, is there a consensus growing here, Craig, about how this industry is going to continue to make this transition to EV? Because it seems like it's slower than maybe they had thought as recently as a year ago, more bumpier. How's this going to play out? Is there any consensus building?
I think there's probably going to be more collaboration. We've heard, the CEO of Renault in France call for an Airbus of autos, a coming together of European companies to try and, confront these challenges together. I think you've seen some analysts call for more collaboration among Western companies and Chinese companies. And we're seeing that in Stellantis, right, where they're teaming up with Leapmotor, one of the smaller EV makers in China. But I do think that there are some real limits to that latter strategy, given the sort of appetite for that in Washington, right? I think it's the one thing that's really uniting Republicans and Democrats is this idea that we shouldn't be at all reliant on China going forward, and that they're our enemy and not our friend.
So what I also find interesting is that it's not just China and it's not just EVs. I mean, specifically, Stellantis said Jeep sales. So it's easy to blame China cheap EVs. It's easy to blame the fact that people don't want to buy EVs right now, but that's not necessarily the only problem.
I think that's a really key insight. I think this was a case of mismanagement on Stellantis' part. And you've seen some analysts come out with really sort of harsh words, not only for the way that they've sort of bungled things, but the way they've communicated. Even just last week, the CFO of the company, was talking about the sort of outlook, and the company has not necessarily been forthcoming, even as one European company after another was issuing profit warnings. For them to sort of drag their feet and only do so now when the writing maybe seemed to be on the wall, even when they were doing first half results. I think that's part of why you're seeing this negative reaction, because some are saying, how can we trust this management team, going forward, given the way they've messaged this.
All right, Craig, thanks a lot. Really appreciate it. Craig Trudell joining us. No, you're not Bloomberg Intelligence. He's Bloomberg Global Autos Editor. I weirdly promoted him, I think.
Yeah, I did the same thing too.
You did the same thing?
Intro, yeah. So
cool. It just means that you're super smart.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, joining us now on the bond market, because you're taking a look at a sell-off pretty much across the curve. You got the 2-year yield up by 5 basis points, 3.6. You're also looking at the 10-year up by about 3 basis points, up at 3.77. Joining us now, RJ Gallo, Senior Portfolio Manager at Fixed Income at Federated Hermes, joining us on the space. All right, what's your best bet on the curve right now?
Well, good morning. Our view on the curve has been for quite some time, and this is a pretty widely held view, is that the U.S. economy is unlikely to turn into a recession, but at the same time, the Fed is completely shifted their focus. They had been almost like a sole mandate inflation-fighting central bank when we had CPI north of 6%, all the way up to 9%, if you recall. They now have shifted gears, and the sort of the weight now is more on the employment side of the mandate. So the Fed's in easing mode. That should bring shorter yields down. At the same time, we're heading into an election. The economy, according to the Atlanta Fed, GDP is still growing around 3%. So longer yields might not come down nearly as much. That's a bit of a steepener, and we've had a good success generating some excess returns to that on a year-to-date basis. On duration, we thought that bonds were going to have a pretty good year this year, and they are. Since April 30th, the U.S. aggregate index is up 8.24%, and the Treasury index is up 7.6%. How's that for a heck of a run for less than a year's time in the bond market?
Exactly. Look at these guys doing laps here. How about the high yield business? That's actually been the best performer year to date, RJ. Why is that, and kind of how do you look at that market going forward?
You're absolutely right. On a year-to-date basis, the Treasury index, just to give some context, is only up 4.08%. The number I shared before was from April 30th. So the Treasury index is just over 4, and the ag is around 470. High yield is almost 8, 7.98%. Why is that? Well, the economy has proven resilient beyond nearly anyone's expectations with respect to the drastic Fed hiking and now easing that has gone on, and the disinflation process that has occurred. The view of a soft landing is a risk asset winner, really. Look at stocks. They're up double digits year to date. If you can have the ability to slow down inflation without sharply slowing down the economy, that's very favorable to risk assets. And that's been wind at the back for high yield pretty much all year. As a firm, I'll be frank, this is a tough business. Sometimes you get them right, sometimes you don't. We've been a little underweight high yield in our multi-sector portfolios, and that's been a little difficult. However, we've made up some of that pain by being overweight mortgages and by playing the curve in the rates direction to some degree. So there's a lot of levers to push and pull in fixed income.
When we talk about, say, the jobs data that's going to come out on Friday, right? I'm wondering, what do you think the reaction function of the bond market is going to be to that number?
With the Fed's shift in mandate, like I was saying a few moments ago, the jobs data becomes all the more important. We went through an extended period there where jobs data took a backseat to inflation. Now that is the opposite. I think that Chairman Powell at the podium recently after the September FOMC suggested that they're going to be sort of mentally haircutting the employment report, especially the non-farm payroll numbers, sort of the headline figure. And that has everything to do with the fact that data out of the Commerce Department, which is used to periodically revise the the payrolls data that we're familiar with from the Bureau of Labor Statistics, the Commerce Department data has been weaker, less job creation. So that took about, I think it was 890,000 jobs or so off the board. And that is, as a result, sort of casting some shade, if you will, in terms of the quality of the data that we get from the Bureau of Labor Statistics. So if we get numbers like, 120, 130, 140, I think that the market will view that somewhat dovishly in a bond-friendly sense, that it sort of keeps the Fed in the game of sequential easing, significant easing to come. Conversely, if the data is really strong, I don't know if yields would rise that much. I think that yield direction in the near term is more symmetric in part because we're heading into an election season. We're heading into an election itself. We've been in the season for a while. The outcome of which could have a significant impact on overall fiscal policy, to include stimulus from extending expiring tax cuts. If President Trump is to return to the White House, we have tariffs and inflation concerns to think about. If it's Kamala Harris, then it's another picture. She also increases the deficit, maybe a little less. Those are factors I think that are going to become pretty important as we get past the election and see what happens next.
I'm a big fan of municipal bond market. RJ, I'd love to get your thoughts on munis here.
You couldn't just wait till Friday? Come on, man.
Exactly.
I know you have the muni moment, but I'm happy to do it here too. It's funny. The muni market came into the year at a relatively rich point. And for those who are in munis, it tends to be a playground for individuals who want relatively high quality investments. The average credit quality of the muni market is around AA, much higher than corporate bonds. They also are very drawn by the tax benefits of interest-free, tax-free interest. And so that's going to bring in people who can benefit the most from it, people who are the top few tax brackets. So the year started out with a lot of optimism on bond returns, higher absolute yields that increases the value of that tax exemption in a sort of taxable equivalent sense. So demand has been pretty good for munis pretty much all year, but that meant we started the year at a sort of a rich point, and then supply has surged. We've had one of the busiest supply years in a very long time. It's up like 35% year over year. It might even be a record year when it's all said and done. So when supply and demand and relative price matter, munis on a year-to-date basis are not up quite as much. As I said, treasuries are up 4, the ag's 4.8. Munis with no adjustment for their tax benefits are only up around 2.9%, 2.2%, depending upon which index you look at. And that's because of that supply-demand pricing picture that we've seen. Right now, munis look sort of reasonably valued, maybe a little bit to the rich side, but their tax benefits are still bringing people in. The muni credit picture looks really good. A number of years ago, people used to fret about muni credit quality crumbling all over the place, at the state level, at the local level.
Yep.
Right now, it's very strong.
Great stuff. See, munis.
Yeah.
In focus coming Friday. Get ready. RJ Gallo, Senior Portfolio Manager, Fixed Income, and Federated Hermes, giving us the breakdown here on the fixed income markets. Again, year-to-date returns across the fixed income space have been solid, kind of mid-high single digits, and even better performance coming off that April low there that we saw a little bit of a dip there. So good returns for fixed income investors, and that is a good thing.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. And every Monday at this time, we tap our great folks over at Bloomberg BNEF, originally or previously known as New Energy Finance. They are the team in Bloomberg that tracks and analyzes the energy transition. And I mean like anything from power to transport, commodities to financing and government government policy, basically. So joining us now is Rowlands Rees. He is BNEF Head of Research. So he does it all. We wanted to focus, though, today on the Inflation Reduction Act. It is very much on the chopping block, and it feels like a binary trade when it comes to the U.S. elections come November. What has happened over the last 2 years in terms of deployment and projects, and what is still left to do?
I think the main thing that has happened, you'll see most of the money will have flowed through into the build out of the power sector, particularly into solar and wind and storage. Now, there's a question of whether that was all going to get built anyway. And what you would say the real value of the Inflation Reduction Act there is being more of a buffer against changing commodities prices. So when the act was passed, natural gas was pretty expensive. It's come down a whole lot since then. So at the time, you might have argued that stuff was going to get built anyway. But with the drop in prices, I think that actually maybe it wouldn't have. So it gave that stability to that sector. Then outside of that, one of the big things we've seen is the development of supply chains, where the US was really at a standing start with regards batteries and solar in particular. Now we're seeing a lot of factories being announced in different states across the country. And then finally, a real uptick in investment in hydrogen. Electrolyzer orders have significantly ticked upwards. Those are some of it's kind of kept the power sector on the steady path that it was on, and then it's really poured fertilizer on the ground of some of these more nascent technologies.
In your world of, kind of managing this transition to a cleaner energy, what is the political risk for this market, for this part of the world, if we were to get a re-election of former President Trump? What would that mean?
It's something we get asked about a lot, and actually we're producing some research right now to really answer that question. I think one of the things that we have concluded is that actually the main provisions of the Inflation Reduction Act are probably safe for a couple of reasons. One is that in the US, it's so hard to change legislation, if you don't have a trifecta. And, whatever the result of the election, a trifecta is somewhat unlikely. And even if there was a Republican trifecta, a lot of the investment from the Inflation Reduction Act is going into states and into districts represented by Republicans. So they would have to have a really big majority in both chambers of the House. So I think there are certain aspects of the Inflation Reduction Act that could change. There's how the laws are implemented. There's a lot of regulations still being written around some of the tax credits, and that could be written differently because that happens in government agencies, which report up to the executive branch. But I think there's less risk than maybe one might assume.
How much money still needs to get deployed? I just was really struck by Sarah Week, for example. It's where all the energy people go and talk about stuff. It's a big conference, happens in Houston every year. It happens in March. And Secretary Granholm was really like, guys, come and get money. Like, we have it. We will give it to you. Come to us to let's give us money. And some people don't like that. Some people are like, that just shows that we're spending money on stuff that we don't necessarily need to spend money on. Yeah,
I mean, it's an interesting one because for the most part, the Inflation Reduction Act is not a pot of money in that the majority of the investment would come through tax credits, which are really just dependent on how much stuff gets built. Where there is a pot of money, and I should have come in with the actual figure, is the amount that's been authorized for the Loan Programs Office. So, and that is the one that is really politically under threat because that was the program in the past that was associated with Solyndra. So there is this perception that this is money being allocated to companies that may fail. And there's a lot of that money still yet to be spent currently, and it's an ongoing process.
What industries are doing relatively well versus their benchmarks versus maybe some industries that aren't? We were just talking to Brian Egger from Bloomberg Intelligence about the cruise industry and their carbon footprint and trying to manage that. Which industries are doing well and which maybe are struggling?
I suppose I think of things on a really macro level. So, I divide the world into power and transport and industry, which obviously is a real simplification. Most of the momentum in decarbonization to date in the US has been in the power sector. Okay. And most of that has been because of gas plants replacing coal plants, which doesn't get you to zero. It just brings emissions down in the near term. So wind and solar is then the next wave, and that's really starting to kick in now. So there is good progress in power. Then transport historically hasn't had great success in reducing its emissions, but I think we're just at the start of the electric vehicle wave, which is going to, I think, be a slow burn over the couple of decades, because even if electric vehicle sales increase quickly, it takes time for the whole vehicle fleet to turn over. But there is a downward trajectory in transport. So it's really industry where what we call the hard to abate sectors where there's more work to be done.
Like cement, steel, that kind of fun stuff. Before I let you go, what I've also noticed when it comes to the IRA specifically, it really helped ignite the demand side of it, right? The supply side of it with tax credits, but not the demand side. So the gap between here's my cool hydrogen thing that I just built, and then here's this company buying that cool hydrogen thing that I just built is wide.
Yes.
How do we solve that?
I mean, that's especially true for hydrogen, and that is fundamentally the issue around the policy support that hydrogen receives is it's so much has been focused on supply. But I think it speaks to a deeper issue of what policy has to come next, because I think the nature of the Inflation Reduction Act was really throwing a lot at all these different industries to get things kick-started. It's a bit like putting petrol in the engine. Maybe not the best analogy since electric vehicles are such, but it put petrol in the engine of the energy transition in the US. But whatever comes next needs to be more like a steering wheel. Because it's established this momentum, but there are all these questions now that are, we never knew we'd have this problem of, there's too much supply, where's the demand? Because at the time there was no supply and no demand.
Yeah.
So the next wave of legislation has to address that, whether it's in hydrogen or other areas.
That's such a great way of steering wheel. I like that. We're going to use that. We're going to steal it. All right, Thomas, thanks a lot. Thomas Rowlands Rees, he is a Bloomberg BNEF Head of Research. Thank you so much.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.